And last but not least, point I want to make is humans tend to be very, very comfortable to rely on technology when human lives are on the line. We can look into medicine, we can look into aviation, we can look into military technology. So whenever things get very critical, people seem to be extremely comfortable to let the computer do the job. And it's quite surprising that there seems to be hesitation when it comes to investment decisions, or actually the execution of an investment decision, because the idea is still generated by the research team, is still generated by humans. It's just the execution of that idea in a maximum consistency, what the machine does. And from my perspective, I'm much more comfortable when I know that my technology is actually doing the trades, as if I would have to sit here every morning to make a discretionary call whether to put that trade on or not.
Research is certainly a key component for managed futures and CTAs. How do you do research at Amplitude Capital? What principles do you apply? Research
indeed is the most critical and vital function that you have in a CTA firm. This is particularly true for short-term trading because the life cycle of a model will be shorter than what you would be able to do in a more medium to long-term trading horizon. The way we organize the research here at Amplitude is that we have regular meetings. There's one big meeting once a week. And apart from that, I manage the projects hands-on on a daily basis. You need to provide a creative environment. Research can sometimes be a frustrating job because you look for things and you invest a lot of time, and maybe at the end of the day, it does not lead to the desired result, and you need to have that tolerance towards frustration to still keep going. And therefore that, I would say, almost pressure-free creative environment is essential. On the other side, it is also important to structure and to manage the research, because otherwise you can almost waste a lot of time and a lot of money without any results that you can implement. To that extent, you will have a loss of efficiency the bigger the team gets. So doubling your research team does not necessarily mean doubling your output. And we have taken the approach to slowly grow the team very carefully, instead of just going out there and hiring 10 or 20 PhDs or master level mathematicians or physicists, because integration into the team and working together as a creative unit is very, very important. Otherwise, you will not be able to generate the necessary output. The other thing is, what's your implementation cycle? Should there be a testing period? We believe that with all the statistics that we can look at, and we usually take the maximum available data going backwards, you should be able to make a decision based on the paper results you see. So operational testing or any test training is purely for operational purposes. We have a pretty short implementation cycle into our live system, and there are ranges of small little implementations basically every month. What is important to note is that it's not a change of the program, it's always an upgrade, which means the correlation of the returns that you generate today with the correlations of the returns that you've generated maybe a year ago is very high, because you want your investors to be able to rely on your return stream specifics, but it's more efficient. So you are less vulnerable in the environments that are difficult for you, and maybe be able to generate more performance in environments that you find that are attractive to your program, so having a better Sharpe ratio. It's all about increasing this efficiency of your program. Then on the other side, the bigger you get, the more important becomes capacity management and execution in your research agenda. When you're a small fund, execution is not that critical yet, so you will spend more time on actually building models and generating the gross returns. But as you get bigger and bigger and bigger, you will spend more time on the research side to be able to put those assets to work. And that is very, very crucial on short-term trading. That's why you see so many short-term funds being closed for investments, because they simply won't be able to handle more assets.
Karsten, that's interesting. Now, in your experience, what have you found is the ideal size for a research team, for a financial research team?
Well, I don't think that we are there yet in terms of size, but I believe an ideal size would be around 25 to 35 people. We currently have we have 10 people in research and IT, so there's still some room to grow. When you grow to a size of 50 or 100 people, you will have a second or a third layer in terms of managing those people. And that is where I believe that you can lose a lot of efficiency. And if you run 20, 30 people, it can still be 1 or 2 people actually managing this group of researchers in a close manner. So I would say that you probably get most out of it at that size. And with those size research teams, you can easily manage $3, $4, $5 billion. That's no problem. Obviously, depending on the capacity of the funds that you have. But this will generate actually plenty of improvement potential that you can put into the programs.
Now, Karsten, in the CTA space and overall in the European hedge fund space, Amplitude Capital is certainly a success story. You started 5 years ago, right? It's a company that was set up predominantly by East Germans that moved to London, who set up the fund there in London. And I think in December of 2008, you moved the whole operation from London to Zug here in Switzerland. So an amazing success story. So in those times, you certainly also learned a lot about regulations in Switzerland, regulations in the UK, and about the global discussions that is now being held about regulations. What is your take? What's your view as a CTA on the regulations, on a discussion? Is this a threat for the industry? Are there opportunities here in this area? What is your take on that?
Well, regulations is one of my favorite topics to talk about. It's very unfortunate that, in particular in continental Europe, the hedge fund industry has become the scapegoat for the financial subprime crisis, but also for the debt and euro crisis that we're facing now here in Europe. So hence, a lot of proposals out there in terms of regulating the industry, and unfortunately, a lot of those proposals are not necessarily very helpful. We know that there's a European directive out there where I guess the most critical part really is the passporting situation that we face, which means that if you're coming from a third country, which means from a non-EU 27 country, you need to passport into each individual European countries where you want to raise assets from or have investors from. So there's going to be no central regulatory body in Europe that you can register with to access those investors. This, I believe the effect would be quite negative on both sides. First of all, for us as a manager, it will reduce the universe of accessible investors. Secondly, also for an investor domiciled in a particular country, it becomes harder for him to source opportunities to invest his money in, because some managers may choose not to get regulated with that particular country. If you have so many countries to choose from, then obviously you go for the ones that you consider most important. So I believe that component of the regulatory proposal is could be quite negative. Hence, we see more and more interest going into UCITs products. So UCITs wrapper would allow you to still market your fund in those countries without obtaining local regulation. The other ideas, and that's depending then really on the strategies that are discussed, is certain disclosures. And obviously that can be quite devastating for funds that, for example, have short positions in single companies. If you would have to disclose a short position, I'm sure the dialogue with that company would be very difficult in the future. We have discussions with regard to leverage constraints, which I personally favor, because that has been one of the main causes for the crisis, that too much leverage was in the system. We have discussions about short selling bans and transaction taxes, which would be negative, not just for the industry, but also for the overall economy, because we know that a dry out in liquidity makes markets less efficient, makes them more vulnerable for market manipulation and potential crashes, and is basically regulatory proposals driven by politicians in Central Europe who have a very, very different agenda than what we have in the UK or what we have in the US. And I hope that in the meetings there will be no global support for these type of measures. I believe overall that we don't really face a threat, but there will be implications that people have to deal with in Europe, such as UCITS products, for example, or certain modifications to your trading that you might have to look at, which the industry will certainly adapt to, and we will have to live with. But it's definitely a factor at the moment that you have to work with, that you have to pay attention to, and that you may have to adapt to.